Welcome to the Thursday edition of the Tech Stocks Daily Podcast. Today we're diving into an action-packed day for NASDAQ's tech giants. Hear how Google's parent, Alphabet, navigates layoffs and antitrust battles while setting sights on strategic acquisitions. Discover why Shopify's stock took a nosedive despite its AI advancements and what the future holds. Learn about Apple's multi-front challenges, from legal disputes to a potential labor strike and a controversial ad campaign. Plus, get the lowdown on HubSpot's market buzz, from unusual trading activities to potential acquisition talks by Alphabet. It's a whirlwind of innovation, strategy, and drama in the tech sector, and you don't want to miss out. Stay tuned. In today's tech circuit, Google, or to be more precise, its parent company Alphabet Inc., found itself swimming in the headlines for a multitude of reasons that span across layoffs, antitrust showdowns, and strategic partnerships, painting a complex picture of the tech behemoth's current state and future trajectory. At the heart of today's discussions is Google CEO Sundar Pichai's approach to company layoffs. Unlike the abrupt mass layoffs seen across the tech industry, Google's strategy unfolds in stages. The company has been under the microscope, with whopping numbers showing around 12,000 employees were let go in 2023. And as we step into 2024, the toll on the workforce continues to rise, impacting core engineering and hardware teams initially, followed by cuts across finance and real estate teams. The layoffs, while sizable, are part of Google's grander scheme to realign its focus towards priority areas, notably AI and cloud advancements. This includes pumping resources into projects like the ARM-based CPU, TPU v5p, Gemini 1.5, and revamps in Google Workspace. These measures, as Pichai outlines, are intended to trim costs while bolstering the company's velocity in the fiercely competitive tech domain. In parallel to internal restructuring, Google's external battlefronts are equally tumultuous. The company stares down the barrel of the largest tech antitrust ruling in 2 decades, a scenario reminiscent of the Microsoft antitrust case of the 90s. This legal quandary revolves around Google's alleged monopolistic practices, particularly its exclusivity contracts with major tech and mobile firms to cement its search engine as the default choice, an issue that even caught Apple in the crossfire. With Google's search engine dominance at about 90% of internet searches, the outcome of this trial could redefine the competitive landscape of internet search engines and set a precedent for handling tech monopolies. Further coloring today's news, Google's collaborative ventures and technological innovations take a brighter tone. The company's expanded partnership with CrowdStrike aims to revolutionize cybersecurity through AI-native integration, potentially setting a new standard for digital protection. Meanwhile, the quirky yet innovative Pocket TV collaboration with Ray Neo promises to enhance the XR glasses experience, offering a tantalizing glimpse into the future of portable entertainment. Additionally, Google's enduring saga with Bright Edge showcases another facet of its ambition as it gears up for the I/O event, with marketers and analysts keenly observing shifts in search generative experiences. These movements underline Google's commitment to staying at the cutting edge of tech, despite facing a challenging operational and competitive environment. In summation, Google, under Alphabet's banner, stands at a critical juncture, balancing ambitious technological pursuits with a delicate corporate restructuring and navigating the treacherous waters of legal scrutiny. It's clear that Google's story is far from static. As the tech giant recalibrates and confronts its multifaceted challenges head-on, the industry watches on, pondering the ramifications of these moves not just for Google, but for the broader landscape of technology and innovation. Shopify found itself in the spotlight today, but the glow was far from favorable, as the multi-tenant, cloud-based, multi-channel commerce platform saw its shares plummet approximately 18.6%, following a downbeat fiscal Q2 2024 revenue forecast. This dive came right on the heels of its Q1 2024 earnings report, where the company did manage to beat earnings expectations, but delivered lukewarm guidance for the future. In the first quarter of 2024, Shopify reported adjusted earnings of 20 cents per share, surpassing the consensus estimate. This demonstrated a significant jump from the 0.1 per share earned a year prior. Revenues also showed healthy growth, reaching $1.86 billion, a notable increase from the previous year's $1.51 billion. Gross merchandise volume on the platform surged to $60.9 billion, exceeding expectations. This growth was partially fueled by Shopify's aggressive push into AI, introducing Shopify Magic, aiming to simplify business operations on its platform with automated listing generation and image edits. However, the standout news from Shopify's earnings call was its projection for the second quarter of 2024. The company anticipates revenue growth to decelerate, targeting the high teens year over year, further softened after adjusting for the sale of its logistics businesses. Gross margins are expected to dip slightly, and operating expenses are forecasted to rise, contrary to Wall Street's expectations for flat growth. These projections signal a stark shift from the prior period's momentum, raising concerns among investors and analysts. This backdrop has sparked discussions around the investment viability of Shopify. On one hand, Shopify's current challenges, such as increased competition from giants like Amazon, Etsy, and eBay, especially in the domain of AI features, complicate its outlook. On the other hand, some analysts remain bullish, with firms like Oppenheimer reaffirming their confidence in Shopify's fundamentals and projecting a possible 45% upside to their stock price target. For investors looking at the broader picture, today's tumult around Shopify underscores the importance of diversification. ETFs with significant holdings in Shopify, like the ARK FinTech Innovation ETF and Franklin Disruptive Commerce ETF, offer a way to stay invested in Shopify while mitigating some of the risks tied to the company's direct stock. The potential for a Federal Reserve rate cut toward the end of 2024 and successful outcomes from Shopify's strategic initiatives could still paint a brighter future for these ETFs. As Shopify navigates through these challenging times, its capability to bounce back and capitalize on the long-term e-commerce growth trend remains a key focal point for investors and market watchers alike. Whether Shopify can tweak its operations and strategy to better compete and improve profitability, particularly in light of their significant investments in AI, will be crucial for its pathway ahead. In today's Tech News Roundup, Apple has found itself at the center of multiple intriguing developments that have caught the attention of tech enthusiasts and investors alike. From a new phase in its ongoing legal scuffle with Spotify, to a potential labor strike at a Maryland store, and the introduction of a controversial iPad advertisement, the Cupertino giant is making headlines for a myriad of reasons. Starting with the escalating conflict between Apple and Spotify, the latter is taking its grievance back to the EU regulators after Apple reportedly blocked updates to allow in-app pricing information, a move aimed at complying with the European Commission's antitrust ruling. Spotify is challenging Apple's new policy, which includes a 27% commission on external links for purchases, hindering the music streaming giant's efforts to bypass this fee. This dispute is set to take center stage as the European Commission considers launching a second investigation into Apple's practices, which may lead to significant ramifications for the tech behemoth amidst accusations of stifling competition. In a separate development, Apple's retail landscape could be on the verge of disruption as its unionized store in Towson, Maryland, gears up for a strike vote. This looming action stems from ongoing negotiations over pay, overtime, and scheduling, marking a critical period for Apple's retail operations. A strike could significantly tarnish Apple's brand image and disrupt its retail activities, especially with other stores, such as the one in Short Hills, New Jersey, contemplating unionization as well. Amid these turbulent developments, Apple is also facing backlash over its latest iPad advertisement, which has been criticized for seemingly celebrating the destruction of traditional creative tools. The ad depicts various artistic instruments being crushed by a compressor, leaving only the new iPad standing, a metaphor for technological replacement that has not sat well with the creator community. Critics, including high-profile figures like Hugh Grant, have lambasted the campaign for its portrayal of Silicon Valley's encroachment on the human experience, overshadowing the launch of the new iPad models equipped with advanced chips and AI capabilities. These stories collectively paint a picture of Apple at a crossroads, navigating legal and labor challenges while also pushing the boundaries of marketing in its quest to remain at the forefront of technological innovation. Whether dealing with regulatory scrutiny, labor relations, or public perception, Apple's actions continue to have a profound impact on the tech landscape and its myriad stakeholders. As the company looks to the future, bolstered by its advancements in artificial intelligence and product development, it must also reconcile with the immediate concerns of competition, worker satisfaction, and community sentiment. HubSpot, a shining star in the marketing software universe, has been buzzing in the tech space today, leading conversations from trading floors to tech forums, and it's not just about their groundbreaking products this time. Let's unpack the whirlwind of news that had HubSpot at the center of tech talk. First off, the stock market is abuzz with talks about HubSpot's recent unusual options activity, signaling big moves by financial whales. A dive into the options history unveiled 34 eyebrow-raising trades with a leaning towards the bearish side. Despite the mixed sentiments, with 23% bullish contra 52% bearish, the trading activities painted a picture of cautious optimism or perhaps strategic hedging, considering the significant value in varied strike prices ranging from $300 to $700. For investors and tech enthusiasts alike, such options activity is a beacon, signaling shifts in investor sentiment and potential future price movements. In parallel, the tech and business world was rocked by news from Bloomberg about Alphabet Inc., Google's parent company, being in advanced talks to acquire HubSpot. This potential acquisition has set the tech community ablaze, speculating about the strategic alignments and synergies between HubSpot's innovative customer relationship platforms and Alphabet's vast ecosystem. The acquisition talks hint at Alphabet's ambition to deepen its foray into the CRM sector, placing it in direct competition with giants like Microsoft, Oracle, and Salesforce. This move could potentially reshape market dynamics, offering businesses enhanced integrated solutions. Adding to the HubSpot narrative, the company introduced an exciting integration with IntroHive, enriching its ecosystem further. This alignment aims to streamline contact management and fortify relationship intelligence, mitigating the challenges of CRM adoption and data quality that plague many businesses. For HubSpot users, this integration signifies a leap toward more efficient operations and richer data insights. And just when you thought that was all, HubSpot's first quarter results topped expectations, firing up analyst optimism. With a revenue uptick and solid growth trajectory, HubSpot's performance amidst a challenging macro environment speaks volumes about its resilience and innovation pace. Adjusted earnings per share and sales figures outpaced estimates, driving positive adjustments in forecasts and reaffirming confidence in HubSpot's market positioning and long-term growth. Today's flurry of HubSpot-related news is a testament to its significant role and influence in the tech and business ecosystems. From the trading floors signaling investor sentiments to strategic corporate movements with Alphabet and innovative integrations that empower businesses, HubSpot is undeniably shaping the future of customer relationship management and marketing. I'm keen to hear your thoughts on these developments. Do you think the potential Alphabet acquisition is a game changer for HubSpot and the tech landscape? How about the implications of HubSpot's unusual options activity or its integration with IntroHive? Dive into the comments section below and let's discuss the future implications of these movements in the tech space. Your insights and predictions are what make this tech community vibrant and informed. All right, let's zero in on Alphabet Inc., better known by most as Google's parent company. If you're following the pulse of the tech landscape, you've heard about the whirlwind of activities around Alphabet, from legal challenges and strategic layoffs to potential groundbreaking acquisitions, notably the buzz around acquiring HubSpot. Given all this, if I had to make a call on Alphabet stock, whether to buy, sell, or hold, my lean would be towards holding, and here's why. First off, the layoffs and restructuring, while initially sounding alarms, are strategic moves by Alphabet to streamline operations and prioritize areas of growth, particularly around AI and cloud computing. This refocusing could bode well for long-term efficiency and innovation, making Alphabet a leaner, more focused machine. The tech giant's emphasis on AI is not just about saving costs. It's about driving the next wave of growth, touching everything from search to cloud services. And when a company leads in innovation, it's often a good long-term bet. Now let's talk antitrust. Yes, the antitrust showdown is a looming cloud, but it's not Alphabet's first rodeo with legal battles. The outcomes of such cases are unpredictable, but Alphabet has a history of navigating these waters deftly. Plus, the tech landscape is no stranger to regulation, and companies of Alphabet's caliber have the resources to adapt and pivot as needed. The potential acquisition of HubSpot is particularly intriguing. This move, if it materializes, could significantly bolster Alphabet's position in the CRM space, pitting it against giants like Microsoft and Salesforce. The strategic implications are profound, potentially opening up new revenue streams and integration possibilities across Alphabet's suite of services. Acquisition news often leads to short-term volatility in stock prices, but for long-term investors, this could be viewed as a strengthening of Alphabet's market position and diversification of its portfolio. Considering these factors, if you're holding Alphabet stock, it might be wise to stay the course and see how these strategies unfold. Alphabet has a track record of turning challenges into opportunities, and these strategic moves could further cement its position as a tech titan. However, and this is crucial, it's important to do your own research. My take here is based on current developments and a view of Alphabet's historical resilience and strategic savvy. Market conditions, regulatory outcomes, and the final details of any acquisition could influence the stock's trajectory. Keep an eye on how Alphabet navigates its antitrust challenges and progresses with its acquisition plans, as these will be key indicators of what comes next. Remember, investing is always a balance of risk and reward, and staying informed is your best tool in navigating these decisions. Whether you choose to buy, sell, or hold, make sure it aligns with your investment strategy and risk tolerance. Listeners, I'd love to hear your thoughts. Are you bullish on Alphabet's future prospects? Or does the current climate have you rethinking your position? Dive into the comments and let's get a vibrant discussion going. Today's tech landscape painted a vibrant yet challenging picture for NASDAQ's tech giants. Google's parent company, Alphabet, maneuvers through layoffs and antitrust battles while eyeing strategic acquisitions like HubSpot, aiming to solidify its foothold in the CRM space. Shopify, on the other hand, grapples with investor concerns following a grim revenue forecast, despite showing robust growth and a deep dive into AI-driven business solutions. Apple's multi-front storyline of legal tussles, potential labor strikes, and controversial marketing strategies highlights the complex environment in which these titans operate. Meanwhile, HubSpot garners attention not just for its performance, but for speculation about its future in the Google ecosystem. In a nutshell, today's events underscore the fluidity and fast pace of the tech sector, marked by strategic plays, legal challenges, and market responses that highlight the sector's dynamic nature. Each story, from layoffs to legal battles to innovative integrations, contributes to the broader narrative of how technology continues to evolve and shape our world. Now, if you found today's summary insightful, show some love by hitting that like button, subscribe for more daily updates, and share this video with your network to keep the conversation going. Come back tomorrow for another round of tech news, bringing you the latest and keeping you informed.